Welcome to Barchart's continuing weekly webinars. My name is John Rowland, and I will be your host for today's discussion about gaps. I've been a trader and an investor for 35 years, and these webinars are intended to showcase you the tools that are in Barchart's website to help you make better informed investment decisions. My part as an instructor is to bring those real world examples and experiences to help sharpen these tools that we have. Uh, Today's presentation is for educational and illustrated purposes only and should not be construed as financial advice or an endorsement to purchase or sell any particular asset. Okay, so just a reminder for us that our webinar is being recorded and that anyone who has signed up for the webinar can will receive an email sometime later today that'll take you a link to it. But if you are first timer, join us for the first time today, we'll welcome, or you're new to Barchart, you can find a listing of these weekly seminars under the tools section and under the free webinars. And you can see today we're talking about affirming trends through gap analysis, and that next week we'll be talking about futures. But here's a lot of those weekly webinars that we have been presenting for the last few months. Okay. So let's go back to our main page. Today's discussion is we're going to work on this page, this tool that we have, which is called our GapUp and GapDown page, and this is what it kind of looks like. It will not kind of look like, so actually what it looks like. All right, and we'll come back and we'll break this down in a little bit. But let me first start by saying to you guys, let's go to this chart. And this is Scott's Miracle Grow, in case you recognize the symbol. And what if I showed you this chart and asked you, how many trading opportunities do you see that would be attributed to gaps? And, you know, most traders would probably look at this and see maybe one or two potential opportunities. But if I showed you the same chart, here's the same chart, what we'll discover is in that same time frame that I showed you in that one chart, there's actually up to 10 trading opportunities here. There might even be more if we dug deeper into that, right? And so today what we're going to do is we're going to learn about these different types of gaps, outside gaps, and how they relate to our trends, and where we're going to train our eye to what is called an inside gap, which is a little difficult to see. And that's because these inside gaps will present greater trading opportunities. We're going to look at gaps that reverse in price and how they can signal a potential change in trend. Right? And finally, we're going to discuss under the right conditions, that there's this cycle of gaps that will help us decide if we want to be an aggressive trader or a passive trader in our risk assessment process. All right. So first, let's learn the story behind gaps and how we can use them to our advantage. Gaps represent the largest imbalance between buyers and sellers of an underlying asset. Gaps or price gaps will gap into an area where the market is able to fill this imbalance between our orders. And that the gap left behind is where there's an absence of buyers, a gap down, or an absence of sellers, a gap up. So let me ask this question for you guys. Who thinks that price goes up because of buying? Now think about that. Who thinks price goes up because of lack of selling? Well, it's actually the latter, right? Price goes up because we don't have enough sellers to satisfy the demand for buying. Think about if I asked you who would want to buy a brand new Tesla vehicle for $500. Every one of you would raise your hand. It's not a lack of buying that would create an opportunity for us to buy at $500. We need a seller to sell to us. The first seller of a brand new Tesla would probably be at, tens of thousands of dollars. So the first price would be much higher. That gap between where we have demand and where we have somebody who's willing to sell. So in this equation of price, a gap is where one side, a buyer or seller, is equal to zero, right? One side of our buyer and seller equation is zero. Remember that price is a record of transaction, and without a buyer or seller, there can be no record. So it's important for us to understand this, because when we look at gaps, when price returns or price comes back to the gap, we know that there's probably still going to be buyers at the origin of our gap, or there might be sellers at that origin gap, and to come into that void. Gaps act like a magnet, right? When price returns to the gap, it draws price into the gap in order to fill that void. And we're going to look at this in more detail, right? So this is one of the ways we're going to use gaps. Gaps will be that signal of an event, right? That's going to alert us of this imbalance. And then we're going to wait for price to return to fill that gap. We'll look later through our discussion to distinguish which is the difference between what is called a gap fill or a gap close. All right, so let's go back to our chart that I showed you before. And what we're talking about here is, see, we have a little gap right here. And this is called an outside gap. We'll make that distinction in a little bit. And price ran away. And then price came back, right? Price comes back. And here's the tail of this candle right here. And notice that that tail lines up with our gap, right? And so price returned to fill that gap. Again, over here, we have a large gap, right? A large gap. And price returned to fill that gap. Once price came back to the gap, it shot away. So this is one of the techniques we're going to use for gap trading. We're going to look at some other techniques, but this is the basic concept of gap trading. Gaps can confirm the beginning of a new trend or affirm an existing trend. And gaps can also alert us of potential trend reversals. So here we see that a downtrending market where price gapped up, and that was the beginning of a reversal of this trend. Then price gapped higher, right? Confirming our trend. And then gap continued to gap higher, again, affirming our trend. And so we'll look at how we can look at the distinction between confirmation and affirmation. All right. And finally, all gaps should be eventually filled. And I know this sounds kind of goofy, but it's something that you're going to start recognizing, that some gaps are filled within the same day, some gaps in a couple of days or a week, and some gaps take months, even years to fill. And what I want you to understand is that, but when price returns to the gap, price remembers, and that's key to our discussion. All right. So let's go back to our, excuse me. Let's go back to our bar chart. Stocks, gap up, gap down. And this is our gap page. All right. And what this page does, it identifies gaps that are in these different stocks, and it'll lay it out for us based on the last price to change, the change, percentage change, how much it gapped up in a value, a price value, and it sorts it by the size of the gap in terms of a percentage. And so for today, what we're seeing is, let me just check on this. We can see that today we've got 329 different markets that have gapped so far today. So that's a lot of markets to look through. But let's kind of just flip through some of these quickly as we're figuring out where we stand. So here's a big price gap, right? This one be a hard market for us to trade at this point. Let's see what else we have. Okay. Again, this is a nice little outside gap, something that might interest me. We'll talk about this gap. This is another outside gap where our price trend is changing, right? So I can continue to look at different markets. Here's a set of gaps that is confirming and affirming our trend, right? And now I've stopped here at Duke Energy. This is a commonly traded stock. And what is going on in this one? Well, first thing I like to do also when I do my gap analysis, I do like to switch to candlesticks because I think it kind of makes for easier for me to see this together. All right. So what I see here is, a market that is kind of in a sideways trend. Maybe some of you might recognize this. This looks like a nice double bottom here, but now price has gapped above a recent swing high, and that will be something that we're going to talk about in a little bit more detail. So this is a market that I'd be interested to watch, right? I'm waiting for the gap to sell, give me that signal, and now I'm going to decide my trade plan or my rules of risk that allow me to take this trade. I might wait patiently to see if price returns to that gap, or wait for a basing action, wait for a price to kind of pause here for a moment, since we did break out above this recent high, and then wait for that trend confirming or affirming price action, right? So this might be one of the ones that I'm interested in watching over a period of time. So I can right click on my chart and I'm going to add it to my watch list. And I have a lot of different watch lists that I've been building over the last few months. And here's my watch list that is on gaps. And we'll look at that one in a second. All right. Okay. So let's see if we can make sense of all these different types of gaps. All right, so we have something that is called a trend gap. And a trend gap is where price gaps in the same direction of our current trend, right? So what I want you to think about when we start thinking about gaps and looking at gaps is what is our trend and how does it relate to our trend? And this is going to give us a clue to our trend, right? Trend gaps tend to confirm a trend and then they can affirm that trend, and then we will see an acceleration of price action of our trend. Now, some folks will say that an acceleration of a gap might be called an exhaustion gap. But it's difficult for us to call us an acceleration gap and an exhaustion gaps at that moment in time, because in order for it to be an exhaustion gap, we need price to retreat from that accelerated motion. So we'll call it acceleration in foresight, and we can call it exhaustion in hindsight. But what I want you to understand is that there's this cycle in right conditions, this cycle of gaps that runs in concert with our trends, this confirmation, affirmation, and acceleration. So I'm going to go back to my charts. These are some charts that I prepared for you guys for this seminar. And this is that cycle that I'm talking about. Here is that gap, right, that changed our price action. Here's the gap that broke that trend, that affirmed our price action. And then here we see that acceleration, that big price movement. And this could be a exhaustion gap, right? Because price is now retreated from here. Now we are basing here, and price could start to move up because in the bigger picture, right, this is a more dominant uptrend. So all we've really done here is now we've popped above all of these most recent swing highs. Now, I think it's kind of ironic, or actually kind of cool, that we can see this, is that where did price stop going up is right where we find some nice technical resistance. But if you can see very closely here, there's a little teeny gap. Now that gap had been filled, but I think it's kind of cool how price respected this major imbalance that first drove the stock price down. All right. Okay, a reversal gap is when price gaps in the opposite direction of our market's trend. And so there's our Devon Energy, another widely held stock. And here we can see that we are in a downtrend, right? And if we think about a downtrend, that would be more sellers than buyers. That's what's driving price down. And we see a lot of gaps here that are gapping down, right? This imbalance between buyers and sellers. Price is gapping down. But then what happens is that price here gaps up. And that could be the beginning of a trend reversal, right? So think about this. if we were in a dominant downtrend where we believe sellers are in control, right, and an imbalance towards sellers, more sellers than buyers, that's because price is falling, would the market be able to gap up? Probably not. So again, this would be one of those candidates that I would be interested at looking at. And so again, what I might do is add this one to my watch list, because now I might be seeing the beginning of a new trend. All right. So let's go back to that original chart that we looked at. And again, now we're thinking about reversals, right? Here is a little gap. It's hard to see here. We're going to learn what this means, this inside gap. But this gap signaled a reversal of this trend. Here we see that price affirmed, accelerated, and then exhausted, right? And then we had a gap down, right? That was a change or a reversal of our trend, right? And now price is moving lower. I do see two smaller gaps. These are inside gaps. We'll make that distinction in a second. But now what has happened? This price correction in my larger time frame trend analysis is now gapped up. And if these sellers were in control, would this market be allowed to gap up? Probably not. And this could be a change in this trend or a confirmation that our larger trend is in control, right? And if we look at a big picture here, this market has been in a nice dominant uptrend with a lot of impulses and corrections. All right. And also we will find a lot of these reversal gaps will come at the end of a correction phase or an end of an exhaustion phase, right? So that's where we'll find those types of gaps. All right, the other kind of gaps that we have are what we call outside gaps, right? And an outside gap is where price occurs outside or above the previous day's high or below the previous day's low. These gaps can be trend affirming and are usually in concert with an acceleration, sometimes referred to as gap and go. Yeah, I think I see a question that's popped up here. Think about, yeah, this is a great tool for those of you who are options traders, right? Because options, it's about deciding where price is going to go or not go, right? So, if you have a dominance of a trend or a trend reversal, that would be a great opportunity to use gap analysis with options trading. All right, so this is Apple. And what's cool about this one is here's what we're going to start looking for. We're going to look for those outside gaps. Now, here is a gap that was outside of our previous day's high, right? And what we want to do for gap and goes is we want them to affirm our trend. In this case, we want the gap or this candle to break or get above a swing high or a pivot high, right, of where price had retreated from. Now, this swing high for Apple happened to be the all-time high on this one. And you can see that from that moment on, every outside gap from that point on continued our trend. All right. Now, many of these outside gaps our catalysts revolve around a news story or a change in the fundamentals of an underlying asset. For instance, earnings or a Fed announcements or a dividend increase in dividends or a stock split. And so this price action that came in Apple was actually the announcement that Apple was going to have I believe it was a 4-for-1 stock split, right? So we can come in here where it says events, right click on my chart, events, and here we see splits. I clicked on splits, and there is the date of the stock split. Now, this is kind of cool because this brings up one of the oldest adages in stock trading, and that is you buy the rumor and you sell the news. So the news event, in this case, the stock split was announced, everybody rushed into buy Apple. And then when the split occurred, well, what did the market do? The trend stopped going up, reversal gap, and price backed off. Now, let me show you another example of this. This is Chesapeake Utilities. And here we see a downtrend, right? And here's our recent swing high. And we've got a large outside gap where price gapped up. Now, it pierced above our weekly high or pivot high here, but it didn't stay above there, right? And so what is the news story that drove this gap? Now, if I go into my price overview, right, Chesapeake Utilities, and I scroll down, and here's that news story that ignited or was the catalyst of that outside gap. Chesapeake Utilities is now going to join the S&P Small Cap 600. So anybody who is a mutual fund manager or an index manager that trades the S&P 600 small cap is going to have to acquire the Chesapeake Utility stock to put it into their portfolio. So the question that we would ask ourselves is this a trading opportunity for price to go higher? Maybe, yeah, as they acquire all of those shares to rebalance their index, but maybe the fundamentals of this company have not changed from this price action. And so this might actually be one of those stocks where we will wait and see what happens with price. Is it going to base and go higher, get above our swing high, or is it going to retreat and fill this gap? Now, if we look at this in a much higher time frame, you can see that we're kind of bouncing off of this technical resistance, however you would define technical resistance. And I kind of define technical resistance as a lot of different tops. And, in order for a price to get going even higher, we've got a lot of wood we got to chop through. All right, so I see another question. Let me just so the question is swing highs. Yeah, so swing highs are where price stopped going up and started going down. So notice in this example here, price was going up and then price was going down. And again, we'll look at swing highs and swing lows in our trend time frame, right? Now, this could be called a pivot high, but it's not a swing high because the high was over here, all right? Okay. The other thing that outside gaps do is that it takes several days for price to return, sometimes weeks before they're filled. All right. So let me go back to my charts. And I want to show you an example of this. So this is crude oil futures. I know we're talking about stocks, but this is crude oil futures. And here you can see a very large gap that occurred in the futures market, and that it took over 6 months for price to come back and fill that gap. But it did fill that gap. Now, it hung out at that gap for a long period of time, but price did remember, right? Now, let me just pause here for a second. When we start talking about gap theory, we can apply it to both stocks and futures. Now, because stocks only trade between 9:30 to 4 p.m. Eastern time, it's a very condensed amount of time that we can trade. So a lot of equities, stocks, will have a lot of gaps from day to day because there'll be some pent up buyers or sellers in the overnight hours between when the exchange are closed. In the futures markets, for instance, crude oil trades for 23 hours a day, and many of our futures markets trade for longer periods of time. So we don't see a lot of gaps. We don't see a lot of outside gaps in futures markets. And so because of this greater time that price can react to news stories. So when we do see a gap in futures markets, they are much more important story. They are telling us something very significant. So if you are a futures traders, you can use all of these techniques, but really respect gaps in futures markets because of this fact that we have access to futures for a longer period of time in any given day. All right, so that's a little bonus kind of stuff for you guys. All right, outside gaps are really easy to see, right? There are these large voids in our charts, right? So they're very easy for us to pick up onto. But let's talk about inside gaps, all right? And an inside gap is created when price opens inside of the previous day's high or low, right? The previous day's close to the new day's opening. Inside gaps tend to be filled within that current day's trading activity, and they can provide a really good day trading opportunities, especially those that are with our trend. These gaps are difficult to see, though, on a chart, right? Because there is no void of space, right? And we need to train our eye for these, all right? So let me give you an example of that. All right, so this is JP Morgan. I think you all recognize that name. And here is a daily chart. And here's our daily candle, right? And here is the opening of that candle. Here's the high of that candle. Here's the low of the candle. And here's the close of that candle. And the next day's candle, the next day's trading, opened below the close. And there's a little teeny gap right here. Let me make it a little bigger for you guys. All right. And so here's our opening price. And that sometime during that trading day, price rallied up and closed this gap. This gap is inside of this previous day's range of price. These are great day trading opportunities for those of us who are more astute or able to train our eyes for these types of gaps. All right. I think there was another inside gap. Let me go back to a different time frame here. Yeah, there it is. Here was a gap. Here's where the market closed. Here's where it opened. This gap, this large gap, was inside of the previous day's range. Now price came back, right, during that day and filled this gap, right? But it didn't close it. It didn't go back to the origin of the gap. It just filled that gap, right? And then price shot away. So it opened up higher, came back, filled the gap, and then price continued to go higher through that day. So inside gaps are tough to see. They are difficult to find, but for my day traders, you will really like these types of gaps, right? All right. So let's go back to our bar chart now that we have a better understanding of all these different types of gaps. All right. All right, so our screener here is giving us a lot of different gaps to look for. And again, we looked at that and there was 300 or so gaps to go through. Again, one of the things, I can do is, quickly go through the flip charts to find markets that I'm interested in. Again, what I said to you was, here was the Duke trade, the Duke market that I liked, and I sent that to my watch list. All right. Well, let me take time here for a second to just go through this. Like all of our screeners that we have inside of our different tool pages, you can look at different types of filters. Here's our main view filter. We do have a technical filter that allow you to look at some of the technicals, moving averages, historical volatility, volumes. We have performance filter as well, right? Year to date, monthlies, 52-week performance, and then fundamentals, earnings and dividends and that kind of thing. So all of our pages, our tool pages, will have these different qualifiers, or what we call screeners. Now, I also have a screener that I've created for myself, and that sometimes this works. Sometimes this will help me narrow out this field of 300. And some of the things that you can think about to create a screener for yourself is, actually, let's go back to this, is I want to think about this volume to relationship to a gap. So a lot of times when we get these reversal gaps, or when we see our trends starting to develop, we'll see an increase in volume. Certainly when we have a big, large gap, you're going to see a big increase in volume on that particular day. But what I'm looking for is a building of volume, a rising volume as my trend is starting to take off, as that first gap has signaled a potential new trend or confirmed a trend. And so what I do is I look at the 5-day volume average as it relates to the 20-day moving average, and I want to see that increase. The other thing that we can look at is a larger volume change, a big volume change, and usually this happens on the day of some of these greater gaps. And I look at for greater than 20% of our 20-day moving average. And I know a lot of you folks, I've been told, use this page in the mornings at 9 o'clock, and you look for that price, those price gaps in the pre-market prior to 9:30 to make those decisions. So a lot of these volume criterias will not play out in that first 30 minutes. What I'm really looking for is the after effects, right? I want to see the volume and the gap. And again, my strategy, a lot of the things that I like to do about gaps is I wait for the gap to help me identify my trend, and I look for those retracements or when price returns to fill the gap. So there's not an urgency to be on top of them. The other thing that I might do is lower the gap range. Now here I just picked 1 to 15%, but I think anything greater than maybe like a 0.5% to 10% would be another way you could qualify this. Or you could even shrink it down to, let's say, a 5%. And so again, sometimes this narrows down our field, and today it does give us 9 different markets to look for, right? Again, I'm looking for trading opportunities, not necessarily for today, but for something to look for in the future. Now, this is kind of interesting. This is Alibaba. And here we have a strong market that is trending higher, and we did have a bit of a correction, right, in price. Now notice that price did come down and fill our gap, and then the next day, right, price gapped up. Well, would the price be allowed to gap up if sellers were in control? Probably not. And then the following day, price gapped above a swing high, right? Or a pivot high in this case. And there we're getting that acceleration, right? So change in trend, confirmation, affirmation, right? So here we're seeing that cycle of gaps. Now, notice now today we are into this gap here. So this could be a cautionary tale in the short term. But if price got above here, I think this is probably our all-time high. That would be another great indication that this trend is in control for me to take that trade. All right. Okay. Now, again, this one, it would be a difficult trade because it's a big price movement. It's only a $2 stock, probably a market I would pass on, right? Here again, a nice trending up market, right? Here's the little gap that confirmed the change in this price action, and now we've got another confirmation and affirmation, right? Again, change in trend and then acceleration, right? Another big acceleration now that has taken out a swing high. And, you can see a lot of these different examples. So let me go back to my watch list, ones that I've been collecting over the last few days. And so again, now these are the ones that I've been watching that are starting to signal those events that I believe in, right? And so this is DraftKings. This is a very popular stock right now. Nice trending up market, right? And let me change this to candlesticks so we can see a little bit better. It's a little easier to see, right? And, again, this is not a real big change in trend, but it is a change in price movement where price then gapped up, and here we can see that price came back and filled that gap. Not only filled it, but it looks like it came very close to closing it. Another outside gap, right? Broke out of a pivot high, and then our acceleration, right? Again, price returned and filled that gap, closed that gap, and then another price acceleration. So that is definitely one of those markets that I would be in control of that trend. Here is one that's a little bit more difficult. Again, price action, change in trend that broke above some swing highs, pivot highs. Here's that confirmation acceleration, and then here's our exhaustion, right? A reversal of our trend action, and price fell back. Now, this one would be one I'd be interested in if price was able to it can continue to go above here, or a nice trade here would be to look for that gap fill. And again, for the gentleman who asked about options, this would be a great example to do a naked put strategy using that gap as a potential strike price. All right. All right. So I do see a couple other questions. Let me just make sure I answer them before we finish up today. Okay. All right. Let's look at a couple other examples here. Here's that Miller Herman. That was the one I showed you again. And you know, here's that affirmation, a change in trend, right? Broke out of a swing high, right? And then price returned to fill our gap. That's kind of how I like to trade them. But again, here's that downtrend, breaking price action, and then again, price action up. And again, those three cycles, the reversal, continuation of our larger trend, and value of our trend continuing to move forward. All right, here's trip.com. Again, a change of our shorter term price action, a breakout above a swing high, pausing of the market. And so this would be an easy, long trade. Look for an entry maybe here, maybe down here, and then let's see if we can get above this high. All right, American Air, excuse me, this is Alcoa. This one's a little bit more difficult. I do see a little bit of a gap here. Notice that price has come back and filled that gap, right? Giving you the opportunity to get into that trade. And now we could see this price go up. Now I do see this gap up here. Again, remember gaps act as a magnet. Again, for my options traders, this would be a great cover call. You would look to use this pivot low or this pivot low over here as a value that we would try to collect with our premium, but we could also set a target based on that that gap there. Here's our Scott's Miracle Grow. Here's that Chesapeake, right? Tesla, another very popular stock. Again, if you were into gap theory, right? Here is the gap that broke out, right? Here's that big candle that broke out above this pivot high and this swing high, right? And then what did price do? Well, price reverted, it remembered where that gap was, and this one closed the gap because it went back to the origin of the gap, and then price shot up. Now, in recent days, we can see that Tesla is literally gapping up and down every day, which is kind of telling me that this market is kind of in a schizophrenic cycle here. So, you know, this might be a more difficult trade. I'm seeing lower highs and higher lows, and this is kind of a wedging formation. So again, some of the gaps that we could see that come out of this, well, you know, we want to make sure that we're either breaking above these pivot or swing highs or going below before we maybe make a commitment to this particular market. All right. Now, the last one that I want to show to you so we can kind of tie this all together is Piedmont Lithium. And so let's watch this unfold. And this is kind of what I've been trying to reinforce, this cycle of gaps as it relates to our trends. So here we can see a market that is kind of in a sideways action. I don't really think we can define it as an uptrend or a downtrend, but certainly in the last few weeks here in the month of August, price has been retreating, not advancing, but just retreating. And then what happens? Well, we get a nice green candle where price opens up above, right? This would be an inside gap, right? Because it's inside of this candle's range, and price opens up higher, And it also takes out a recent pivot high. The next day, price gaps up again. Again, a now confirmation of this price action. And it doesn't take out our swing high, but that's okay. I don't mind markets that pause or pivot, pause or consolidate at these swing levels. That's actually a good sign as long as price continues to advance. Boom, nice big candle, right? Another acceleration of price, right? This gap is confirming our price action. And here we can see that we are breaking above this most recent pivot high, not the swing high, but pivot high. Another candle, green candle. Our trend is in control, right? Another green candle. Trend is in control. Buyers are pushing the market up. Sellers are retreating. And boom. Now we get a gap, an outside gap that breaks above that swing high. A affirmation of our trend. And then boom, look at this. A big price movement where price not only breaks up on an acceleration, but it also breaks this most recent swing high over here. And again, another affirmation of our trend. And so at any point in this time, this could be a gap and go strategy, depending on how you defined risk, how you would feel to take this trade. But each one of these gaps is still confirming to you that your trend is in control. Now, some folks would say at this point that this big acceleration of price is one of those big acceleration price movements, and that this could be a potential exhaustion gaps. But again, what we said was it's difficult to call it an exhaustion gap until we see a reversal of price, and that this is just an acceleration of price, because check this out. Bang. All of a sudden, this stock shot up almost $20. And matter of fact, on this particular day, it went all the way up to almost $55. So just from one teeny little inside gap where we had a change in our trend or a confirmation of a beginning of a new trend, this trade, rewarded you almost, $40 in a very short period of time. Now, this is not normal. This is an extreme. Now, this could be our exhaustion gaps, right? For my candlestick traders, here's a nice evening star. And then you do see that here's our closing price here, here's our opening price here, an inside gap that did not get closed, but a reversal of our trend. And so that price now is probably going to retreat. Now, how far could it retreat? Well, let's see if we make a base, or that maybe price might retreat all the way back to the origin of this big explosive movement. All right. Okay. So I do see a question is, can I show my screener again? Yeah. So let's go back to that. And here it is, screener. And I'm assuming this individual is asking about what are the different components of my screener. And again, if you have any questions that are related to what we've talked about today, about how to use bar chart tools or screeners or any of the ways to manipulate your charts, make sure you send your questions to support at barchart.com, and those folks will help you through that process. If you have a question or a specific question about the strategies or the content of the presentation that I've put forth today, when you send those questions into support, just make a note that you'd like that forwarded to me. And I do answer all my questions. It just takes me a few days to answer. Just make sure that the questions are more about the strategy and the concepts and not on any particular individual stock, right? So don't ask me, would you take this trade, or do you think that this is a good buying opportunity? I'm not going to answer those questions, okay? All right, so that's pretty much what I wanted to show you guys in terms of gaps. Before we leave today, I do want to mention to you guys that as a premium member, you do have access to a lot of premium tools. And I want you guys, those who are new to the webinar series or first-time visitors here, is that you can sign up for access to premium tools on a 30-day trial period. For those of you who are in that trial period, I would encourage you to go for it, right? Because I really believe that when you look at the cost of a yearly subscription for Barchart premium services, I mean, it's about the same as a month of Starbucks visits. And I think the information and the quality of the material and tools that are available to you will pay for itself in a very short period of time. And so that I think it would be an investment well spent. All right, so that is kind of the little pitch for us. Again, I will remind all of you that we will have a webinar next week, so join me next week on Wednesday, October 7th. We're going to talk about futures risk management techniques. What we're going to do is we're going to look at futures markets that are a little bit more dynamic and look at some rules or some generalities to help us find some greater targets and also to help us manage our risk. One of the greatest or most common mistakes traders make, especially futures traders, is they let a winning trade turn into a loser. And so we're going to look at rules or permissions that we're going to give ourselves to allow us to move our stops, to lock in profits, and to reduce risk. So I would encourage you guys to come and join us next week. Until then, I hope and wish all of you the best of trading. Before I jump away, again, let me just make sure there's no questions that I can answer at the moment. Okay, I think we're pretty good. Again, thanks for being with us, and I will see you guys next week.